What if we told you that a majority of actively managed funds fail to beat their benchmarks? Wouldn't that make you question the need for active management? The rise of passive investing is a direct response to this, and two popular avenues dominate this space: index funds and exchange-traded funds, ETFs. But which one suits your needs better? In this video, we'll dive deep into their differences, strengths, and weaknesses to help you decide. Stick around till the end to find out which option aligns with your investment goals. The rise of passive investing. Passive investing has seen exponential growth in recent years. In 2018, the total assets under management, AUM, of passive funds were 1,22,000 crore rupees. Fast forward to 2022, and this number skyrocketed to 6.36 lakh crore, an astonishing 400% jump in just 5 years. So, what's driving this trend? The low cost, minimal maintenance, and simplicity of passive funds are appealing, but the underperformance of active funds stands out as a significant factor. For instance, in 2022, 67% of large-cap active funds underperformed the Nifty 100 index. This isn't an isolated case. Mid-cap and small-cap funds have struggled similarly. With such numbers, investors are increasingly turning to passive options like ETFs and index funds. But how do these two compare? What are ETFs and index funds? ETFs and index funds are both forms of passive investments that replicate the performance of an underlying index, like the Nifty 50. However, they differ in how you invest in them. Index funds operate like mutual funds and can be purchased through mutual fund platforms with minimum investments as low as 100 rupees. ETFs, on the other hand, trade on stock exchanges like individual stocks, requiring a demat and trading account. While index funds are simpler and more accessible for beginners, ETFs offer lower expense ratios and better tracking efficiency. These differences make each option appealing to different types of investors, depending on their needs and familiarity with stock market operations. Expense ratio. Comparison. Expense ratios are a key factor to consider when choosing between index funds and ETFs. Both options generally have low expense ratios, but ETFs often have an edge due to their passive management and streamlined structure. Index funds, while also low cost, may carry slightly higher expense ratios because they often require investment minimums and are tied to mutual fund management practices. For instance, ETFs like the Vanguard S&P 500 ETF typically boast expense ratios as low as 0.03%, while comparable index funds may range around 0.1%. Over time, even minor differences in expense ratios can significantly impact returns, making ETFs a better choice for cost-conscious investors seeking long-term growth. Tracking error, a crucial metric. Tracking error measures how closely an investment replicates the performance of its benchmark index. It's a critical metric for evaluating both index funds and ETFs. A lower tracking error indicates that the fund more accurately mirrors the index, which is ideal for passive investors. ETFs typically exhibit lower tracking errors due to their real-time trading mechanisms and efficient structure. In contrast, index funds may encounter slight deviations because they are priced at the end of the trading day and occasionally face cash drag when reinvesting dividends. Understanding tracking error helps investors assess whether the chosen vehicle meets their expectations for aligning with the index, ensuring more consistent and predictable returns. Returns, ETFs versus index funds. When comparing returns, ETFs and index funds generally perform similarly, as both aim to replicate the performance of a specific benchmark. However, slight variations can arise due to factors like expense ratios, tracking error, and tax efficiency. ETFs often edge out index funds in tax efficiency since they use in-kind redemptions, minimizing taxable events. Additionally, lower expense ratios in ETFs may slightly boost returns over time. On the other hand, index funds can occasionally outperform due to reduced trading costs for long-term holders who don't need intraday pricing. Ultimately, the difference in returns between the two is typically marginal, with both providing reliable growth aligned with their respective indices. Liquidity, the double-edged sword. Liquidity is a key feature distinguishing ETFs from index funds. ETFs, traded on stock exchanges, offer intraday liquidity, enabling investors to buy or sell shares throughout the trading day. This flexibility appeals to active traders seeking to capitalize on price movements. However, this advantage can also tempt frequent trading, which may erode returns through transaction fees and poor market timing. In contrast, index funds trade only at the end-of-day net asset value, NAV, discouraging impulsive transactions and promoting a disciplined, long-term approach. While ETFs provide greater liquidity, it's a double-edged sword, offering flexibility but also the potential for misuse. Choosing between them depends on your trading habits and investment strategy. Price-to-NAV gap. One critical difference between ETFs and index funds is the price-to-NAV gap. ETFs trade on exchanges, and their market price can fluctuate throughout the day due to supply and demand. This often results in a price that slightly deviates from the net asset value, NAV, of the underlying assets. While arbitrage mechanisms typically keep the price close to the NAV, extreme market conditions can widen this gap. In contrast, index funds are always bought or redeemed directly at the NAV, ensuring no price discrepancy. For investors prioritizing precision and stability in pricing, index funds eliminate this variability. ETFs, however, offer the flexibility of intraday trading despite occasional price disparities. Ease of access. Index funds and ETFs differ in how easily they can be accessed. ETFs are traded on stock exchanges, making them available to anyone with a brokerage account. You can buy or sell them during market hours, just like individual stocks, providing flexibility and convenience. Conversely, index funds are purchased directly from mutual fund companies or brokers, typically at the end-of-day net asset value, NAV price. While ETFs require a brokerage account, index funds may have higher minimum investment requirements, which can be a barrier for some investors. Both offer simplicity, but ETFs cater more to investors seeking quick and flexible transactions. Tax efficiency. ETFs are generally more tax efficient than index funds due to their unique structure. When investors redeem shares of an ETF, the fund can use an in-kind creation and redemption process, which minimizes taxable events. This means capital gains are less likely to be distributed to shareholders. In contrast, index funds often have to sell securities to meet redemptions, potentially triggering taxable capital gains. Both investment types are tax-friendly compared to actively managed funds, but ETFs stand out as a preferred choice for investors focused on minimizing tax liabilities. Which one should you choose? Choosing between index funds and ETFs depends on your investment preferences and financial goals. If you prioritize simplicity and plan to invest steadily without monitoring the market daily, index funds are an excellent option. They suit investors comfortable with end-of-day pricing and minimal trading activity. On the other hand, ETFs are ideal for those seeking flexibility, real-time trading, and potentially lower expense ratios. Active traders or investors looking to fine-tune their portfolios often prefer ETFs. Both options provide low-cost diversification and are great for long-term investing. Ultimately, the best choice aligns with your trading habits, tax considerations, and desire for convenience versus control. Both ETFs and index funds have their strengths and weaknesses. ETFs offer lower costs and better tracking, but require a demat account and careful monitoring. Index funds provide ease of use and accessibility, but come with slightly higher expenses. Ultimately, your choice should align with your investment goals, risk tolerance, and level of expertise. By understanding these nuances, you're already one step closer to making an informed decision and achieving your financial goals. If you found this comparison helpful, don't forget to like, share, and subscribe for more insights. Thanks for watching. See you in the next video.